Hello and welcome back to Audiobook 101, the place where powerful book summaries come to life. Here, we don't just listen, we learn, we grow, and we apply those lessons to real life. Are you just getting started in the world of investing? Do terms like stocks, bonds, and mutual funds leave you feeling confused or overwhelmed? If so, you're not alone, and you're in the right place. This summary has been specially crafted for beginners who want to understand how investing really works without the jargon and complexity. Whether you've never invested a single dollar or you're just starting out, this guide will give you the tools you need to build a secure financial future. The authors of this book, true experts in long-term, low-cost investing, will show you how to save smartly, invest confidently, and create a lifestyle of lasting wealth. So if you're ready to take your first step toward financial freedom, let's dive into the Bogleheads Guide to Investing. But before we dive into the first chapter, I have a small favor to ask. If you find this summary helpful, please give it a like, drop a comment, and subscribe to the channel. And if you know someone who might benefit from this, share it with them. It might just change their financial life.
Choose a sound financial lifestyle. Imagine this. If you took 100 Americans at age 25 and tracked them until they turned 65, statistics suggest that by retirement age, only one of them would be truly wealthy. Just 4 would be financially independent. The remaining 95, they'd still be struggling, some relying on government aid, others on family support, and many simply unable to retire at all. Now think about that. The United States is one of the richest countries in the world, yet only 5% of its people manage to achieve financial freedom. Why is that? To understand the reason, we first need to ask, what kind of financial lifestyle are you living? Are you a borrower, a consumer, or a keeper? Let's start with borrowers. These are people who don't worry much about tomorrow. They live entirely in the moment. Take Bill and Betty, for example. They drive luxury cars, wear expensive jewelry, and live in a grand house. On the surface, they seem successful. But behind the scenes, their entire lifestyle runs on borrowed money. Credit cards, loans, EMIs. It's all debt. What they're doing isn't building wealth. In fact, they're digging a financial hole, accumulating what we might call negative wealth. If they were to lose their jobs or face a sudden emergency, their entire lifestyle would collapse like a house of cards. The cars would go. The house might be repossessed. And eventually, their possessions could be auctioned off. Friends and neighbors might assume they're doing well, but the truth is, it was all built on credit. Borrowers enjoy life today by gambling away their future. Now, let's look at the second group, the consumers. James and Kathy are a typical example. They buy things within their budget, whether it's a phone, a car, or a vacation. They make sure it fits their income. They don't live lavishly, and they don't take on much debt. They also try to save, but expenses are often so high that there's little left to put aside. Their lifestyle is clearly better than the borrowers, but here's the catch. They haven't planned for the long term. They're not moving toward financial independence. They're simply staying afloat. Then there's the third group, the keepers. People like Kin and Kim. Their mindset is different. Their income might be the same or even less than that of borrowers or consumers, but they always seem to have more money on hand. Why? Because they follow a simple, powerful habit. They save at least 10% of their income and invest it. These are the people who quietly build real wealth. They might retire early, live stress-free, and never worry about their bills again. Keepers don't live on impulse. They live with intention. They don't just earn money, they grow it. So now ask yourself, which lifestyle are you living? And more importantly, which one do you want to live? If this made you realize how essential investing is, then you're already ahead of the curve. But before jumping into the world of investing, there are 3 simple truths you need to understand. First, shift your mindset from a paycheck mentality to a net worth mentality. There's a difference between income and wealth. Income is what you earn. Wealth is what you keep. Even if you make $1 million in a year, if you spend it all, you've gained nothing. Saving isn't about earning more, it's about keeping more of what you already have. Second, eliminate high-interest debt. Before you invest a single dollar, pay off any high-interest loans or credit card balances. Why? Because no investment will give you a guaranteed return as high as the interest you're paying on debt. Think of it this way. Paying off debt is like getting a risk-free, tax-free return on your money. And third, build an emergency fund. Life is unpredictable. A sudden illness, a car accident, or job loss can strike at any time. You need cash on hand for those moments. And don't stop there. Protect yourself further with the right insurance. That way, you're not just preparing for growth, you're protecting what you've already built. Start early and invest regularly. In 2005, John Bogle, the founder of Vanguard, and a group of Bogleheads gathered for dinner in Florida. During the evening, Mr. Bogle shared a fascinating letter he had received from a Vanguard shareholder. This man had been investing since the 1970s, and his portfolio had grown to over $1.25 million. But here's the surprising part. This investor never earned more than $25,000 a year. Now pause and think about that. How does someone with a modest income become a millionaire? Did he rob a bank? Win the lottery? Strike it rich through some lucky break? None of that. The truth is far more practical and far more powerful. He simply invested consistently over time. This story beautifully illustrates the incredible power of compound interest. What Albert Einstein once called the most powerful force in the universe. You see, many people with lower annual incomes believe the only way they can become rich is by hitting the lottery. But the odds of winning the lottery are lower than being struck by lightning. It's a fantasy, not a strategy. Becoming wealthy doesn't require luck. It requires patience, discipline, and time. One key concept to understand is the rule of 72. This simple formula helps you estimate how long it will take for your money to double. Just divide 72 by your annual rate of return. For example, if your investment earns an average return of 8% per year, your money will double in 9 years, because 72 divided by 8 equals 9. That's the magic of compounding. Your money not only grows, but the growth itself starts to grow. Over time, the results are exponential. And the best part? Anyone can do this. You don't need to be a finance expert. You don't need to earn 6 figures. You just need to start early, stay consistent, and live below your means. The core rule is simple. Spend less than you earn. Save at least 10% of your income, no matter how small it may seem. The earlier you start, the bigger the reward. And yes, it might require sacrifices. You may need to buy second-hand instead of new, ride a bicycle instead of owning a car, eat out less often. Every small saving adds up. You could even consider moving to a more affordable city, a cheaper neighborhood, or even a country with a lower cost of living. The goal is to cut your expenses wherever possible so you can save and invest more. Because in the end, wealth doesn't come from what you earn. It comes from what you keep, grow, and protect over time. Know what you're buying. Before you start investing, it's important to understand the different types of investment options available to you, like stocks, bonds, treasury securities, mutual funds, and annuities. Each comes with its own purpose, level of risk, and potential reward. The more you understand them, the better your decisions will be. Let's start with stocks. When a company issues stocks, it's essentially offering pieces of ownership in its business to the public. So, when you buy a stock, you're becoming a partial owner of that company. After the initial public offering, IPO, stocks can be freely bought and sold in the market, usually through a stockbroker. Brokers charge a fee for this service, and the value of a stock can go up or down depending on market conditions. Next, we have bonds. Buying a bond is like lending your money to a company or government in exchange for interest. Over time, you earn regular payments, and eventually, your original amount is returned. In short, bonds provide income through interest. Bonds can be issued by corporations, government agencies, or the U.S. Treasury. Among these, U.S. Treasury bonds are considered the safest because they're backed by the full faith and credit of the U.S. government. Now let's talk about mutual funds. Think of a mutual fund as a basket that holds a mix of stocks, bonds, or other investments. Many investors pool their money together, and a fund manager invests it on their behalf. Mutual funds come in two main styles: active management and indexing. In indexing, the fund simply tries to match the performance of a benchmark index, like the S&P 500, which tracks the top 500 companies in the U.S. It's a passive approach, low in cost, and proven to work well over time. On the other hand, active managers hand-pick stocks and bonds they believe will outperform the index. While this sounds promising, it usually comes with higher fees, and historically, most active funds fail to beat the index in the long run. Finally, there are annuities. These are insurance contracts that provide you with a fixed income for life, typically after retirement. While they offer stability and peace of mind, they also come with complexities and fees that must be fully understood before purchasing. Today, you don't have to figure all of this out on your own. There are countless trusted resources online where you can explore these investment options in greater depth. The key is to keep learning, stay curious, and make sure you fully understand where your money is going before you invest. Preserve your buying power with inflation-protected bonds. And how much do you need to save? Inflation is like a silent thief. It doesn't break into your house or steal your belongings in the dead of night. Instead, it quietly robs you of something far more subtle, your future purchasing power. Imagine you have $1,000 today. 10 years from now, you might still have that same $1,000 in your savings account. But here's the problem. It won't buy you what it can today. Prices rise, and the value of your money slowly erodes over time. It's easy to think, well, I haven't lost anything. My money is still there. But the truth is, you've lost something invisible yet critical. What that money can actually buy. Just ask your grandparents what they used to purchase with a single dollar decades ago. You'll likely hear stories that sound impossible today. That's the impact of inflation, and it never sleeps. This is why protecting your purchasing power is just as important as saving and investing. One effective tool for this is inflation-protected bonds, like U.S. Treasury. Inflation-protected securities, TIPS. These investments adjust for inflation, helping your money retain its real-world value over time. But now comes the next big question. How much do you need to save? There's no one-size-fits-all answer. The right amount depends on a few key factors. 1. How much you're saving today. Your current age. The younger you are, the more time you have to let your investments grow. 3. The age at which you plan to retire. 4. How long you'll need your retirement savings to last. 5. The expected rate of inflation. In simple terms, the earlier you start, the easier it becomes. The longer you wait, the more you'll need to set aside to catch up. Also, don't make the mistake of relying on inheritance or family wealth for your retirement plan. You may retire while your parents are still healthy and active, and their money may not be available to support your future. Your retirement should be built on your savings, not someone else's. By considering all these factors, your income, your age, your goals, and the effects of inflation, you'll be able to determine how much you really need to save to build a secure and independent future. Because true financial freedom isn't just about having money. It's about knowing that your money will still matter tomorrow. Keep it simple. Make index funds the core or all of your portfolio. Most people don't realize this, but many stockbrokers and mutual fund managers don't actually make money by outperforming the market. Instead, they earn by charging fees that come out of their clients' pockets, not their own performance. But here's something surprising. If you choose to invest your money on your own without relying on high-fee managers, there's a 70% chance you'll outperform the market average over the long run. Why? Because you're not losing money to unnecessary management costs, commissions, and trading fees. In life, we're often taught a few common principles. Never settle, always aim for the best. Follow your heart. Seek expert advice if you're unsure. Act fast during a crisis. History repeats itself. These might be great rules for living, but when applied to investing, they can be dangerous. As an investor, aiming for the best return might lead you to chase risky stocks. Following your heart might push you into emotional decisions. Acting fast during a market crash could cause panic selling. And assuming that history will repeat itself might blind you to new realities. Sometimes, good investing means doing the opposite. Settle for a reasonable return, and you'll likely do better than most. Ignore your emotions and stick to the plan. Don't chase experts, especially if their advice comes with a hefty fee. Stay the course, even during market turbulence. Accept uncertainty, because no one can predict the future. This is why index funds are so powerful, and why many experts recommend making them the core, or even the entirety, of your investment portfolio. With index investing, you don't need deep financial knowledge, special skills, or constant attention. You simply invest in a fund that mirrors a specific segment of the market, like the S&P 500. And let time and compounding do the work. Index funds come with ultra-low fees, no active managers, and no need for constant monitoring. You don't have to pay a broker, and you don't have to hire someone to watch your portfolio day in and day out. Just invest, automate, and forget about it. Over the long run, this simple strategy has consistently beaten the majority of actively managed funds. It takes the guesswork out of investing and replaces it with quiet, steady growth. So if you're looking for a smart, low-stress, and effective way to build wealth, keep it simple and let index funds do the heavy lifting. Asset allocation, the cornerstone of successful investing. Asset allocation is the process of spreading your investments across different asset classes to reduce risk. It's based on a simple but powerful idea. Don't put all your eggs in one basket. If one basket drops, your entire plan won't shatter, because your other baskets are still intact. But how exactly do you do this? It begins with asking yourself two fundamental questions. 1. What kinds of investments should I choose? 2. How much of my money should I allocate to each one? Answering these questions has led to the development of several important investment theories. One of the most well-known is called the Efficient Market Theory, EMT. Back in the early 1900s, a young French mathematician named Louis Bachelier wrote a PhD thesis that laid the foundation for EMT. This theory argues that it's nearly impossible to beat the market because all known information is already reflected in stock prices. In other words, the market is always a step ahead. About 20 years later, a student named Alfred Cowles analyzed over 7,500 predictions made by financial services firms. He compared these predictions to the actual performance of the stock market. The result? He concluded that these firms were unable to accurately predict market movements. Fast forward to 1973, Burton Malkiel, a Princeton professor, came to the same conclusion. He published a now classic book titled A Random Walk Down Wall Street, which popularized the idea that trying to time or predict the market is a losing game. His message was clear. Markets are unpredictable, so stop trying to outsmart them. If predicting the market doesn't work, what should investors focus on? That brings us to another key theory. The modern portfolio theory, MPT, developed by Nobel Prize winner Harry Markowitz. MPT emphasizes the relationship between risk and return and how to balance them to build an efficient portfolio. Let's say you have two investments with the same expected return. Investment A grows steadily without much volatility. Investment B swings wildly up and down, but eventually ends up with the same return. Which one would you choose? Most people would choose investment A, and that preference for stability is called risk aversion. It's a core concept in smart investing. Now that we understand these theories, let's bring it back to you. Ask yourself these 4 essential questions. 1. What are your financial goals? 2. What is your investment time frame? 3. How much risk are you comfortable taking? 4. What is your current financial situation? Are you saving for your child's education, planning for retirement, or working toward buying your first home? Your goal determines not just how much you need to save, but also how your portfolio should be structured. If you need the money in a short period, say 3 years from now, for college tuition, stocks might not be the best option. The market could dip right when you need to withdraw, and you'd be forced to sell at a loss. It's also important to assess your risk tolerance. Only invest in volatile assets if you have the emotional and financial strength to endure potential losses. And of course, your overall financial situation plays a big role. For example, someone who has a guaranteed pension or stable future income may not need to save as aggressively for retirement as someone who has no pension or fallback support. Smart asset allocation is all about balance between growth and safety, between long-term goals and short-term needs. And when done right, it becomes the foundation of successful investing. Costs matter. Keep them low. Mutual fund taxation. In many areas of life, we assume that the more we pay, the better we get. But when it comes to mutual funds, that logic falls apart. In investing, every dollar you pay in fees is a dollar you lose in potential returns. That's why keeping your investment costs as low as possible is essential. Mutual funds typically come with 3 types of charges. 1. Front-end sales charges. 2. Deferred sales charges. Back-end load. 3. No-load fund fees. Let's break them down. A front-end sales charge is also called a purchase load, a commission. you pay when buying into the fund. This fee reduces the actual amount that gets invested. For example, if you invest $10,000 into a mutual fund with a 5% front-end load, only $9,500 will be invested. The remaining $500 goes to the broker. Now imagine this. A year later, the fund reports a 10% return. At first glance, it looks like you've earned $1,000, but in reality, you only earned 10% on $9,500, which is $950, not $1,000. That's the hidden cost of high fees. Next, there's the deferred sales charge, also called a back-end load. This fee is charged when you sell your fund shares, especially if you sell within a short period. The longer you hold the investment, the lower this fee tends to be. In many cases, if you hold the fund long enough, the charge may disappear altogether. Lastly, we have no-load funds. These funds don't charge front-end or back-end sales commissions, but they still come with some basic fees like purchase fees, account fees, exchange fees, and most importantly, management fees. These can eat away at your returns over time, especially if they're higher than average. Now that you understand how mutual funds can quietly drain money from your investments through various charges, it becomes clear why low-cost index funds are a smarter alternative. They don't require a broker, don't charge sales loads, and come with minimal management fees. In short, costs matter a lot. But there's one cost that hits even harder than fees: taxes. Let's look at an example. Suppose someone invested $1 in a tax-deferred account in 1963. After 30 years, that dollar would grow to $21.89. Now imagine if that same investment had been made in a taxable account instead. After 30 years, the value would be just $9.87. That's less than half. This is the impact of taxes over time, and it's massive. So, how do you reduce your tax burden? Start by minimizing turnover in your portfolio. Constantly buying and selling mutual funds can lead to higher capital gains taxes, especially on short-term gains, which are often taxed at double the rate of long-term gains. Instead, hold your investments for the long haul. The longer you hold, the lower your tax liability, especially when gains are classified as long-term. Also, whenever possible, choose tax-efficient accounts such as IRAs or 401ks in the U.S., where your investments can grow either tax-deferred or tax-free. Remember, it's not just about what you earn, it's about what you keep. And keeping your fees low and your taxes under control is one of the most powerful ways to grow your wealth over time. Diversification, performance chasing, and market timing are hazardous to your wealth. You've probably heard the old saying, "Don't put all your eggs in one basket." Well, that advice applies perfectly to investing. Putting all your money into a single stock or company is like gambling your entire financial future on one roll of the dice. If that company fails, your investment could vanish overnight. The smarter approach: diversify your portfolio. Spread your money across different assets to reduce risk. Sometimes a stock might look extremely promising. Maybe it's all over the news or friends are raving about it. But no matter how tempting it is, never give in to greed. Diversification is your safety net, and diversification isn't just about owning different stocks. True diversification means also including bonds, index funds, mutual funds, or even other asset classes. That way, if one part of your portfolio underperforms, the rest can help balance things out. Another common mistake investors make is chasing past performance, believing that whatever did well last year will keep doing well in the future. But the market doesn't work that way. Past performance is never a guarantee of future results. In fact, the top performing fund today might be one of the worst performing funds 5 years from now. Take the case of the 44 Wall Street Fund in the 1970s. At one point, it was considered one of the best performing funds in America. Investors were lining up to put their money into it. But by the early 1980s, the same fund had become one of the worst performers. Many investors who had bought in late suffered massive losses. Financial TV shows and magazines often hype certain funds or managers with bold claims like, "This portfolio beat the market." It sounds convincing, professional, even trustworthy. But more often than not, it's just clever marketing. Here's an example. Smart Money magazine once hosted a contest between two portfolio managers, Ron Barron and Robert Markman. The challenge lasted 1 year. If you had followed Ron Barron's portfolio, you'd have lost just 1%, which might seem bad at first, but keep in mind that the overall market, S&P 500, declined by 12% that same year. So relatively, Barron performed well. Now, if you had followed Robert Markman's portfolio, you'd have lost a shocking 64% of your investment. So, what does this tell us? There's no guaranteed way to know whether one manager will outperform another, or whether either one just got lucky. And even if one performs well short term, there's no telling what will happen in the long run. Magazines and media run these contests not to help investors, but to boost their own sales and ratings. It might be entertaining to watch, but it's not wise to base your financial future on headlines or short-term predictions. The lesson? Diversify wisely. Avoid chasing hot trends. Ignore short-term hype, and stick to a long-term plan. Because building wealth isn't about hitting home runs. It's about consistency, discipline, and protecting yourself from risk. Savvy ways to invest for college and how to manage a windfall successfully. Let's start with a simple truth. The more education you receive, the more you're likely to earn over a lifetime. That's why parents across the world invest their hard-earned money into their children's education. The goal? A brighter future and better job opportunities for the next generation. Statistics consistently show that college graduates earn more than high school graduates, and high school graduates earn more than dropouts. Education pays, quite literally. If you're planning to save for college, there are several smart investment options to consider. One of the simplest is personal savings under the parent's name. This gives the parents full control over how and when the money is used, and there are no income restrictions for contributing. Another option is a custodial account, often used to hold birthday money, gift money, or cash saved over time for a child's future. It legally belongs to the child, but is managed by a parent or guardian until they reach adulthood. Each saving strategy has its own pros and cons. No single option fits everyone, so it's a good idea to read a couple of books or seek expert advice to find the best plan for your situation. Now, let's say you suddenly come into a large sum of money. It could be from a lottery win, an inheritance, a divorce settlement, an insurance payout, or selling a business. This kind of unexpected money is called a windfall, and while windfalls can feel like a blessing, they also come with emotional weight, like joy, anxiety, confusion, or even guilt. A lottery winner might feel overjoyed at first, but also overwhelmed or unworthy. Someone who just sold their business may feel proud, but suddenly purposeless. After a divorce settlement, some feel hopeful, while others feel lost or hurt. The emotions are real, but so is the risk of mismanaging the money. That's why it's crucial to handle a windfall with care. Here are 4 smart steps to follow. 1. Park the money in a safe account and don't touch it for at least 6 months. 2. Create an estimate of what the money can actually buy, not just what it looks like on paper. 3. Make a wish list of what you truly want to do with this money and your life. 4. Seek professional help from someone qualified, like a certified financial planner or CPA. But why wait 6 months? Because during that time, your emotions may cloud your judgment. Decisions made in emotional highs or lows are rarely wise. Most intense feelings, whether excitement or grief, tend to settle within half a year. Also, large sums of money can create an illusion of lasting wealth, even if it's not enough to support a lifetime. That's why it's smart to make a realistic estimate of what your windfall can and cannot afford. Once you've done that, create visions for your future. Do you want to change careers? Quit your job? Move to a new city or country? Your wish list should reflect what truly matters to you, not just what looks impressive. Finally, until you gain the financial knowledge to manage it all yourself, work with a trusted professional, a certified public accountant, CPA, or financial advisor can help you make the most of your windfall, protecting it from poor choices, unnecessary taxes, or emotional decisions. Because when managed wisely, a windfall isn't just money. It's an opportunity to reshape your life. Do you need an advisor? Track your progress and rebalance when necessary. Years ago, a broker once joked with his friends about a saying that was popular at his brokerage firm. When someone buys or sells an investment, the broker makes money, the brokerage house makes money, and 2 out of 3 isn't bad. It might sound funny, but it reflects a deeper truth. A brokerage firm's primary goal isn't to grow your wealth, it's to make a profit. And how do they do that? By encouraging clients to buy and sell frequently, generating more commissions in the process. So ask yourself, whose financial future are they really serving? Yours or theirs? Relying blindly on a broker to manage your money is a bit like asking a fox to guard the henhouse. You might get advice, but is it truly in your best interest? That's why the best path for most people is to become a DIY investor, someone who takes ownership of their financial decisions. Anyone can print a business card with titles like financial advisor, investment consultant, or wealth planner. But in many places, there are no strict qualifications, no mandatory certifications, and no licensing exams required to use those titles. And yet, many people trust these so-called experts more than they trust themselves. Even if you decide to hire a professional for guidance, remember this: you still need to be an informed and educated investor, because no one will care about your money as much as you do. As a smart investor, one of your key responsibilities is to rebalance your portfolio periodically. Over time, market movements can shift your asset allocation away from your intended plan. Maybe stocks have grown faster than bonds, or maybe certain sectors have underperformed. Rebalancing means adjusting your investments to bring them back in line with your original strategy. This process not only helps manage risk, but it also naturally encourages you to sell high and buy low, one of the smartest investing habits you can develop. You don't have to do this alone. There are easy-to-use tools and software programs like Quicken or MS Money that can help you track your portfolio and rebalance when necessary. The key is to stay involved, stay informed, and stay disciplined. Because in the long run, your success won't come from flashy tips or perfect timing. It'll come from making smart decisions, avoiding unnecessary costs, and staying committed to your long-term plan. tune out the noise. Mastering your investments means mastering your emotions, making your money last longer than you do. Back in 1980, very few Americans invested in the stock market, but today, more than half the population owns marketable securities. This growing class of investors has created a wave of interest, and with it, a booming investment media industry. From TV shows and podcasts to financial blogs and newspapers, we're constantly bombarded with forecasts, expert predictions, and bold investment advice. Some of this content can be educational, but much of it, it's just noise. Many of these so-called forecasts are nothing more than sales tactics wrapped in fancy language. And even books, yes, even bestsellers, can sometimes be misleading. Just because a book is selling millions doesn't mean it's sharing the truth or offering sound financial guidance. Publishers care about sales, not your savings. That's why the most powerful strategy you can adopt is simple. Don't let outside noise control your financial decisions. Stick to your plan. Trust the principles of long-term investing. And above all, master your emotions, because once you've built a strong portfolio, you're faced with an entirely different question. How do you make your money last as long as you do? The answer depends on several key factors. The current value of your portfolio, your life expectancy, unexpected health care costs, sudden changes in pension income or insurance coverage. To get a clear picture, use a trusted online financial planning tool. These programs can help estimate how much money you can safely withdraw each year, so you can live comfortably without the fear of running out of funds. And here's something important to remember. Don't be wasteful, but don't be excessively frugal either. Many people are so afraid of outliving their money that they deny themselves basic pleasures, even when they can afford them. They live in constant fear, hoarding every penny and never allowing themselves to enjoy the very wealth they worked so hard to build. Take the story of Jacob Leader, for example. Despite having millions in assets, he drove a beat-up old car, lived in a tiny home, and didn't even have cable TV. He had no children, rarely went out, and often spent his days lounging at his girlfriend's house. He'd call his broker using her phone and only dined out at the cheapest restaurants, if at all. When Jacob died in 1997, it was revealed that he had left behind a staggering $36 million fortune. Even his girlfriend was stunned. She had no idea he was sitting on a mountain of wealth. Jacob's story is a powerful reminder. Wealth is not just meant to be preserved. It's also meant to be lived. So while it's important to plan wisely and prepare for the future, don't forget to enjoy the present. Because the goal of investing isn't just to die rich, it's to live well. Protect your assets by being well insured. Passing it on, when you pass on, you can do it. Life doesn't always go as planned. Accidents happen. Jobs are lost. Marriages end. Health fails. Financial crises strike when you least expect them. That's why being prepared isn't just smart, it's essential. No matter how carefully you save or invest, one unexpected event can unravel everything. That's why insurance is not a luxury. It's a financial safety net. Here are 5 types of policies everyone should seriously consider. 1. Life insurance. 2. Health insurance. 3. Disability insurance. 4. Property insurance. 5. Long-term care insurance, especially for aging parents or elders. Many people overlook these essentials. They remember to buy extended warranties for their cars or TVs, but completely ignore health care or life coverage. The irony is, we often insure the things we can afford to replace and ignore the things we can't. So, here's the rule of thumb. Insure only what you cannot afford to lose. Life insurance, for example, is meant to provide financial support to your family if something happens to you. But if no one is financially dependent on you, you may not need it. Choose what truly matters. Don't fall into the trap of over-insuring the wrong things. Now let's talk about your journey as an investor. Maybe you're just starting out. Maybe you've made some mistakes. That's okay. Every successful investor once made beginner mistakes. What matters is that you're learning and you're moving forward. By now, you've learned how to choose a sound financial lifestyle, save consistently, and start early. Understand the basics of stocks, bonds, and index funds. Keep costs and taxes low. Stay diversified and emotionally disciplined. Protect your wealth with proper insurance. And plan for a future where your money outlives you. So here's your next step. Make a plan and stick to it. Build your portfolio with low-cost mutual funds or simple index funds. Use the many online tools available to track your progress and rebalance when needed. Don't chase fads. Don't let fear or greed control your decisions. And most importantly, believe in yourself. You don't need a financial degree to build wealth. You don't need to be perfect. You just need to be consistent, patient, and disciplined. The road to financial freedom is not always fast, but if you stay on the path, stay informed, and stay committed, you will get there. So go ahead, start today. This is your journey. This is your life, and you can do it. Thank you for listening to this summary of The Bogleheads Guide to Investing. We hope it gave you clarity, confidence, and the motivation to take control of your financial future, one smart decision at a time. If you found this valuable, please give it a like, drop your thoughts in the comments, and don't forget to subscribe to Audiobook 101 for more life-changing book summaries. And if you know someone who's just starting their financial journey, share this with them. It might just be the guide they need. Until next time, keep learning, keep growing, and remember, your wealth begins with what you do today.